gold and silver prices surged to record levels early in 2026, and while they remain historically high, it's safe to say they're taking a breather for the time being. However, many experts agree that another leg higher is coming. And if they're right, that means now could be a good time to get positioned in the market. With that in mind, I recently asked 7 experts what they would tell a new investor looking to deploy $10,000 in the resource industry. While the answers were varied, common themes emerged, and I think the information will provide a helpful base. The question was specifically about how a young investor could allocate $10,000, but I think the replies could apply to anyone who's entering the resource sector for the first time. If you're a more experienced investor, I'd love to hear your thoughts in the comments about how you'd put $10,000 to work in the mining space. Without further ado, let's get into it. First up is Rick Rule of Rule Investment Media. The veteran resource investor and speculator often emphasizes the importance of investing in yourself before actually starting to invest in a commodity or stock, and he went in that direction with his comments.
First of all, they should do nothing for 6 months, and they should study. They should invest in themselves. As a young investor, intellectual capital preserves physical capital. So read things like The Intelligent Investor, read things like Securities Analysis, read things like Economics in One Lesson. For 6 months, do nothing. And then after 6 months, don't follow your greediest instincts, but employ the lessons that you learned from reading, which will necessarily put you into the biggest and the finest companies in the natural resource space. If you are a youngster, particularly if you're male, aggressive, you will tend to be a reward chaser rather than a risk manager, and you will likely lose most of that $10,000. If you invest in yourself first, and you invest then with a much more measured approach, employing the lessons that you learned, that $10,000 will be your first step to a fortune.
Brien Lundin of Junior Stock Review also spoke about building knowledge and understanding mining sector basics before jumping in. Here's how he explained it.
So the first thing I would do is look at the royalty companies. I think, and I've in my presentation I'm going to be giving later today in the letter writers, I talk about, playing to your strengths, but most importantly, understanding and admitting to yourself what you don't know. And if you're a newbie, realistically, you probably know nothing when it comes to geology, engineering, finance, or accounting. Maybe accounting is the one that you could probably rely on. It's maybe the most straightforward. And I would say that sets you up best to start at the top. Get your feet wet with understanding balance sheets, with understanding how these companies grow on the macro scale, and then work your way down as you gain more book experience and more investing experience down to the maybe mid-tier producers, the advanced developers and such. The exploration is always so sexy, and that's where people want to go. But I'm telling you, for a newbie investor, it's not the place to start. Take your time and do that. So I would start at the top if I had $10,000, and hopefully in a year or so I'd be looking to come down into maybe the more risky stuff as I gain more knowledge.
Brian's point about starting with producers before working down to developers and explorers was echoed by a number of other experts. Notably, Brien Lundin of Gold Newsletter said right now is a better time than usual to own gold producers. Given the metal's current price, some offer potential that rivals smaller companies.
I would open an account with a discount broker, and if you're in the U.S., it trades in Canada and can get stocks on the Canadian exchanges. And I would allocate, if it's $10,000, probably among 5 good companies. I would probably include 1 or 2 of the producers. This is one of the rare times and perhaps only time I've ever seen where the gold producers, given the money that they're putting out and the amount of re-rating that would be necessary to reflect current metals prices, they offer potential that would rival those of junior exploration plays and discoveries. But I would get a couple of big producers, and then I would focus on some developers, near-term producers, and a couple of exploration plays.
Jaime Carrasco of Harborfront Wealth Management got more specific, saying he'd use $7,000 to buy a good quality levered silver producer and put $3,000 into an early developer.
And there, I would definitely start with a good quality levered silver producer, that's going to give me the leverage. And the one that I do buy in that spectrum, there's one in Argentina and one in Mexico. I don't want to say the name because like Nico, Eagle, First Majestic, those, I've talked about them forever.
Yes.
Right? So definitely start there. And I would say, okay, let's put $7,000 of the $10,000 into that. Then take the $3,000 and buy a nice early developer that's still ridiculously cheap, right? There's an amazing one in Peru that owns the Corani mine. The Corani mine is a 400-year life mine. Once that's up and running, it's going to increase the GDP of Peru by about 10%. It's that big, right? But it's got to be built. Now that's going through changes in management, but I've always said, I don't care who owns it. I just want to own that mine.
Okay.
Right? And that has massive upside because once that mine's up and ready. So that's a developer, right? And then if you have a little bit more money than $10,000, then go and buy an Explorer.
If you do decide to go down the food chain, David Erfle of Junior Miner Junkie urged caution, explaining that at least for gold and silver juniors, it's harder right now to find stocks that are still cheap and provide strong upside. Here's what he said.
But you really have to do your homework and put it into the right ones, because it's almost even more difficult now because at this time last year you could pretty much sling a dead cat and not miss an undervalued junior. And these late stage companies with all this gold in the ground that were de-risking these projects, they were so cheap. But now they're not cheap anymore. I still think they're undervalued, but they're not as cheap anymore. So where you get the multi-baggers now are in the higher risk companies. And they're higher risk for a reason, because they're basically they've just put out a mineral resource, or they're just about to put out a PEA. So they still got a long way to go, lots of dilution, and lots of things that can go wrong.
Taking a slightly different perspective, Joe Mazumdar of Exploration Insights suggested investors start by deciding which commodity they want to focus on.
One, think about your own thesis. Are you thinking gold? Are you thinking silver? Are you thinking critical minerals? Then once you got the commodity sorted out, then you figure out how much work do you want to do on this investment. Because if you don't want to do any work, then just buy an ETF, either on the commodity or on the equities, depending how much leverage you want. And then if you want to do more work, then go into production. If you want to do more work, then look at development. If you want to do like very high risk and want to do even more work, then you can go into exploration. So manage how much work you're willing to do on your investment in terms of the liquidity of that asset. The more liquid it is, you don't have to do a lot of work, because if you make a mistake, you can get out right away. Problem is, as you go into the juniors, if you make a mistake, you'll eat that for a long time. It'll be hard to get out.
Tavi Costa of Azuria Capital got even more specific, breaking down how he would divide $10,000 between different commodities. These are his comments.
I think I would put some maybe $3,000 or so into agricultural commodities, just because the timing of things. I would put another $3,000 to $4,000 into energy, and I would look for some maybe copper miners as the remainder. I think that sounds. Yeah, I mean, that would probably be at one place to be separating the capital. I mean, I'm just trying to think here out loud, but yeah, I like the symmetry of agricultural. I like the trending of energy, and I like the long-term idea of mining. So I suspect that agriculture will be your most asymmetric bet in the next 2 years or so. But you said long-term, so I think mining looks very attractive for long-term, and could be your biggest winner. So, yeah.
Thank you for watching. Don't forget to let us know in the comments what you think of this advice, and if there's anything you'd do differently.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.